Bitcoin was sold as digital gold, then it fell 33% in a war. So here's the puzzle. For a decade, Bitcoin was sold as digital gold, a scarce hedge that's supposed to shine when the world breaks. Well, in 2026 the world broke, a US-Iran war and record global debt. Exactly the storm a hedge is built for. So Bitcoin soared, right? No, it fell, from about $93,000 at the start of the year to around $62,000, down roughly 33%, one of the worst performing major assets of 2026. A crisis hedge that sells off in a crisis isn't really a hedge. So what happened to digital gold? The answer is hiding in one number almost nobody watches. Reason 1. The diversification is statistically dead. The whole case for digital gold was that it sags when stocks sig. But through 2026, Bitcoin's correlation with the S&P 500 climbed to a record, from an average around 0.4 before the tension, to as high as 0.9 in peak windows in April. On some days, almost all of Bitcoin's move was explained by what stocks did. Now, that exact number is soft. It swings a lot by window and by source, so hold the decimal loosely. But the direction is unmistakable. Bitcoin stopped trading like a separate asset and started trading like a leveraged bet on the Nasdaq. Reason 2. The market repriced it as a rates asset, not a safe haven. Watch what actually happened on the July strikes against Iran. A real hedge, rallies, and a war headline. Bitcoin did the opposite. It dipped to a 24-hour low around $61,500, down about 1.2% on the day. Why? Because the market now runs Bitcoin through the same chain as a tech stock. War pushes oil up. Oil pushes inflation up. That keeps the Fed hawkish, which lifts short-term yields, and higher yields get Bitcoin sold. It now tracks front-end treasury yields more tightly than tracks gold or crude. So the war headline that should have lifted a hedge pushed digital gold down instead. Reason 3. Follow the plumbing. When spot Bitcoin ETFs launched, they did something subtle. They put Bitcoin into the exact same allocation bucket as tech stocks. BlackRock's and Fidelity's funds channel billions a day from the same portfolio managers who trade the S&P and the Nasdaq. So when those desks trim risk, they sell Bitcoin right alongside their Nasdaq futures. One risk-off click, and both go down together. That's how an asset built to be independent became a high beta proxy. And it shows in the damage. Bitcoin is one of the worst performing major assets of the year, sitting roughly 47% below its all-time high near $126,000. Same owners, same bucket, same exits. Now the honest other side. In the most recent shock, the July 13th strikes, Bitcoin actually held around $62,000, while gold slid, dropping from about $4,133 to roughly $4,022 on a stronger dollar and rising yields. A rotation bull looks at that and says, it was gold that failed this time. And Bitcoin is being repriced as the new fixed supply hedge, not betrayed. And they have a point on the data. The correlation number is genuinely soft, swinging by window. One outlet even cited a flip down to 0.13. So the betrayal is contested, not closed. Here's the clean test to disprove the whole bear case. If that 30-day correlation falls back towards 0.4, and Bitcoin rallies on the next real risk-off event, so what actually settles it? Not the price. A hedge is allowed to fall. What defines digital gold is behavior. It's supposed to move differently from stocks when things break. And in 2026's biggest stress test, it didn't. It moved with them. And it fell on the exact news a hedge should love. The number that matters isn't the 33% drop. It's the correlation. As long as Bitcoin trades in lockstep with the S&P, it's functioning as a leveraged risk asset, not a crisis hedge, whatever the marketing says. If that lick breaks and it starts zigging when stocks sag again, the digital gold story can come back. Until then, the behavior is the verdict. So, back to the puzzle. What happened to digital gold? In the exact year it was built for, a war and record global debt, Bitcoin didn't hedge. It fell about 33%. It moved in near lockstep with the S&P, and it sold off on the war news. So the honest verdict isn't buy and it isn't sell. It's a status on one specific claim, the digital gold crisis hedge story. Broken. Bitcoin may still be a great long-term bet on adoption. That's a completely different debate. But as a hedge, in the one moment that counts, it traded like leveraged tech. Watch 3 things: whether the correlation falls back towards 0.4, whether it rallies on the next risk-off shock, and whether ETF flows ever decouple from tech. One last note. The prices and correlations here are from public market data and reporting. The read on what it means is AI-assisted, educational, and not advice. Not a call to buy, sell, or hold Bitcoin. An asset can be a long-term winner and a failed hedge at the same time.